This is a drama, in fact, a rise, a fall, and rise again story. And one of the protagonists of the story is Adam Neumann.
When you sort of mention Adam Neumann and WeWork, people often say, like, isn't that the guy who got really rich while investors lost everything? And that's accurate.
What was once the U.S. most valuable startup just declared bankruptcy? Not too long ago, it was like a shooting star in the business world, trying to change how offices work. The person leading it wanted to create a new way of working together with shared spaces and a sense of community. It quickly became really famous and got a lot of money from investors, making it worth a lot. But just as fast as it became popular, it faced big problems. Bad decisions, money troubles, and too much pride in the company has caused its downfall. Now it's dealing with too many offices available and not enough people wanting them, dealing with tough competition and economic ups and downs. But how did the once famous company from Silicon Valley end up losing more than 99% of its value?
How fast are you growing?
Very.
That 2 years ago, the value of WeWork was zero. Company was on the verge of bankruptcy. Company had run out of cash, and the fact that we've taken from zero to a valuation circa $8–9 billion in 2 years is great.
What kind of numbers are we talking about?
We're talking about probably one of the fastest physical expansions that has been seen for the past 10 years.
I'm just going to give you one data that you realize the power of WeWork. Second quarter, WeWork is less than 1% of all of London commercial real estate, office space. We amounted for 37% of the leases. So that tells you that the future is bright. That tells you that people want a flexible workspace.
In 2010, Adam Neumann and Miguel McKelvey founded WeWork. Neumann and McKelvey had developed an environmentally conscious co-working space called Green Desk in 2008, but decided to sell that company to their partner and invest the proceeds into starting WeWork. At the most basic level of description, what WeWork does is sign a long-term lease for some office space, spend some money making that space more inviting, and then rent that space out to other companies or individuals on a short-term basis. Although the idea of office subletting was not a new one, WeWork clearly offered a new take on the idea. Their spaces were designed to be creative, collaborative, and aesthetically pleasing. The opposite of cubicle-heavy 20th century office spaces. The rental terms were flexible, with monthly terms available. The concept quickly caught on, at first appealing to individuals and small companies, but eventually also attracting larger companies who were looking for overflow office space or a quick way to experiment with new locations. But WeWork was more than just a contemporary take on renting out short-term office space. The company saw itself as a community company, a disruptive revolutionary in the mold of Uber or Airbnb. The comparison with Uber and Airbnb is apt, not only because WeWork was a high-profile provider in the sharing economy, but also because it didn't take long for WeWork to reach the stratospheric valuations characteristic of unicorns, such as Uber and Airbnb. Neumann, the CEO and face of the company, acknowledged in a 2017 interview that those valuations did not represent just the core business prospects. Our valuation and size today are much more based on our energy and spirituality than it is on a multiple of revenue. And much of that energy flowed from Neumann himself, who was as ambitious as he was idealistic. A colorful and charismatic individual, his goal for the company was to elevate the world's consciousness, and his goal for himself was to be the world's first trillionaire. His ambitions even reached as far as world peace. He was quoted in New York Magazine as saying, "I need to have the biggest valuation I can, because when countries are shooting at each other, I want them to come to me." Neumann's wife, Rebecca Neumann, shared similar ambitions, telling a podcast interviewer that she knew he was the man that was, hopefully, going to help save the world. Ms. Neumann later became the company's chief brand officer and the head of a private school started by the company called We Grow. In January of 2019, WeWork rebranded itself as the We Company, representing its expansion into education and other industries. For several years, Adam Neumann's ambition paid enormous dividends. In 2014, WeWork was launching 10 locations a year. By 2019, WeWork had locations in dozens of countries and was the largest commercial tenant in Manhattan. It rose to a private valuation as high as $47 billion. Some observers wondered why an office subleasing company should have such a high valuation, but Neumann argued that because his company was growing as fast as the fastest-growing tech companies, and because it relied so heavily on technology, its valuation should resemble the valuations enjoyed by tech companies. As Neumann moved to take the company public, one of the banks vying for underwriting duties suggested that the IPO valuation might be as high as $100 billion. Despite or perhaps because of his ambition, Neumann was impulsive and often made snap decisions, including suddenly banning meat at the company without explaining why. This ban apparently didn't apply to himself, as he was seen eating meat even after the ban. Rebecca Neumann shared some of these impulsive tendencies. For example, she was known to have employees fired after first meeting them because she didn't like their energy. Adam Neumann also engaged in behavior that generated a conflict of interests. He trademarked the word "we," decreed that WeWork change its name to the We Company, and then charged his own company $5.9 million for the permission to use the trademark. He also used part of a $500 million line of personal credit issued by investor banks to purchase an ownership stake in several of the buildings in which WeWork leased office space. As WeWork continued to grow, problems started to crop up. In 2015, the company was involved in a labor dispute involving office cleaners. The following year, WeWork laid off roughly 1,000 employees. Shortly after that 2016 layoff, Neumann held an all-hands meeting in which he explained the need for the firings. The meeting was followed by an unexpected party in which shots of tequila were handed out, while Daryl McDaniels, aka the DMC of Run DMC, gave a private concert. Needless to say, some of those present at the meeting wondered about the propriety of throwing this kind of party. And in June of 2019, multiple former executives sued the company, alleging gender and age discrimination. Additional investment in WeWork fueled an increased focus on rapid growth. Turning a generic office space into a WeWork space requires significant renovation on top of leasing costs, which means that a new location will need to operate successfully for months, if not years, before turning a profit. Rapid expansion involves more and more of these front-loaded startup costs, which in turn involves greater and greater financial losses. Add to these expansion costs various extravagances, such as summer camp, and it's not hard to see why WeWork's chase for growth produced annual losses in the hundreds of millions of dollars. This growth-first, profits-later approach culminated in a $1.9 billion loss in 2018 and a loss of over $2 billion in 2019, roughly $5.5 million per day for the entire year. As of August 2020, the We Company was on track to be profitable in 2021, but its path to profitability required that the company cut its workforce by 60%, from 14,000 in 2019 to 5,600 in 2020. Private investors were willing to put up with the financial losses as long as the growth continued, and they were also willing to put up with Neumann's excesses and idiosyncrasies. But after the We Company filed its pre-IPO paperwork in August of 2019, it quickly became clear that the general investing public was growing more and more skeptical. Widespread concerns about the business model and about Neumann's behavior, including the numerous conflicts of interest, caused the IPO to be delayed and eventually withdrawn. The ongoing uproar and the loss of support from some of Neumann's most important backers forced Neumann to step down from his position as CEO in September. As of May 2020, the company's valuation had plummeted to $3 billion from its peak of $47 billion. Although the controversy has mostly subsided, the fallout from the failed IPO continues. SoftBank offered a $3 billion bailout package in October 2019 after the IPO had been canceled, but withdrew the offer in April 2020 due to some of the conditions not being met. This decision has resulted in at least 2 lawsuits, first from the WeWork board and then from Neumann himself. To make matters worse, the coronavirus pandemic was not kind to the We Company. In March of 2020, the company's credit rating was downgraded from B- to CCC+, dangerously close to being in default. And by April, WeWork was trying to secure rent concessions from its landlords in the face of $47 billion in future rent liabilities. It's interesting to note that $47 billion remained an important number for the company, but as a liability rather than a valuation. Even after the pandemic, WeWork will likely continue to be affected by reduced revenues, resulting from fewer tenants per location due to the need for additional spacing and fewer tenants overall. WeWork's struggles have also had an adverse effect on the broader commercial real estate market and on mortgage-backed securities in particular. For example, the price of bonds backed by WeWork lease payments dropped sharply in the second quarter of 2020.
In terms of what we've seen with some of the hot IPOs that are money losers, this is like another one.
We know that they've been struggling for years, especially after the pandemic. What's going on?
The most that have lost money 12 months before they've done their IPOs. WeWork's the second most money-losing IPO after Uber.
The investor concerns that destroyed WeWork's IPO went deeper than the behavior of Adam Neumann. Potential investors weren't happy with the amount of money the company was losing, and they had concerns about the overall business model. Around the time of the failed IPO, WeWork's long-term liabilities and short-term tenants' business model had produced a wide discrepancy between incoming and outgoing rents. $4 billion in expected rental income, with an average tenant lease of 15 months, compared to the aforementioned $47 billion in rental liabilities, with an average lease of 15 years. Even in 2018, observers were pointing out that this lease arbitrage model was risky because it was vulnerable to decreases in demand for office space, exactly what happened during the coronavirus pandemic and the ensuing recession. Similar companies have actually been through the same cycle. Regus was a company with a similar business model that grew quickly in the 1990s, but went bankrupt after the dot-com bust. Thus, the pandemic-caused recession exposed the vulnerabilities of WeWork's business model in a dramatic way. Even after the worst of the pandemic was over, the global shift to remote work meant that tenants were slow to return, with some deciding never to return at all. This also had ripple effects in the broader industry, as commercial landlords affected by WeWork's struggles became less willing to rent space to companies who planned to sublet it as office space. Another fundamental problem was that WeWork was valued as a tech company, even though its balance sheet did not look very much like a software company's balance sheet. One useful metric is gross margin, expressed as a percentage, which can be calculated by dividing profits by overall revenue. Software companies typically have gross margins above 75%. For example, Zoom's gross margin was 81% in 2019, but WeWork's gross margin in 2019 was only 20%. The dramatic failure of WeWork's IPO, together with the lackluster results of other recent tech company IPOs like Lyft, Uber, and Slack 7, has brought about a shift in investor focus. Instead of focusing exclusively on growth and ignoring losses, Silicon Valley is returning to the old-fashioned strategy of making a profit. Perhaps this shift would have occurred without WeWork's meltdown, but it does seem as though the WeWork disaster has brought about significant changes in the behavior of investors. A final complaint to consider is that WeWork's approach, at least when Neumann was at the helm, exacerbated the negative effects of hustle culture. In the 20th century, broadly speaking, there was a relatively clear distinction between work life and personal life. There were, of course, plenty of exceptions to this rule. At some point during the early 2000s, however, as the millennial generation was entering the workforce, technology companies such as Google became known for offering extensive workplace perks, free food, massages, and ping-pong tables, to mention just a few of the typical perks. Certainly made the workplace a more enjoyable environment, but these perks inevitably led to workers spending more time at the workplace. In a related trend, college students and graduates seeking employment were urged to pursue your passion and do what you love. These two trends, among other factors, led to increased working hours and an expectation that all of one's best energy should be directed into job performance, a mindset exemplified by hashtags like #TGM, thank God it's Monday. As Elon Musk said on Twitter, nobody ever changed the world on 40 hours a week, but if you love what you do, it mostly doesn't feel like work. There is, of course, nothing wrong with working hard or loving your job, but hustle culture appears to be causing widespread burnout and depression, especially among millennials. The WeWork culture is, if nothing else, a hustle culture. WeWork locations include throw pillows decorated with the "Do What You Love" slogan and signs that tell tenants to hustle harder. And one location went so far as to carve "Don't stop when you're tired, stop when you're done" into the cucumbers inside a water cooler.
WeWork filing for last night bankruptcy. Chapter 11 announcing a restructuring plan that includes a $3 billion debt for equity swap.
They have been burning through $300 million a quarter of cash 4 years after pledging to restructure, to rationalize. It's just completely untenable.
WeWork has filed for bankruptcy and is seeking court approval to reject 69 commercial real estate leases that it says are underperforming, more than half of which are in New York, after filing for Chapter 11 protection in the U.S. Bankruptcy Court in New Jersey on Monday. It is also in talks with hundreds of landlords to amend other leases. WeWork Chief Executive David Tolley said roughly 90% of the company's lenders have agreed to convert their debt into equity, wiping out about $3 billion in debt. On the 7th of November, WeWork said that most of its existing shares would be deemed worthless as part of its proposed reorganization plan, except for those held by SoftBank, which holds more than 50% of the company's common shares. WeWork said in court papers that SoftBank will instead cancel its existing debts and retain its existing shares. Approximately 56% of the company's shares outstanding are owned by subsidiaries of SoftBank's Vision Fund. WeWork is facing the consequences of excessive expansion that left it with many unprofitable locations. The office space provider signed hundreds of long-term office leases at the top of the market in the late 2010s. It spruced the spaces up and effectively sublet them for as little as a month at a time. That business crumbled when demand for its desks fell and vacancies rose during the pandemic, while WeWork remained on the hook for billions in rent payments to landlords. WeWork's losses totaled around $16 billion as of June, as it churned through all the money it raised from top investors and lenders over the past decade. A more than $5 billion bailout from SoftBank, its biggest backer, also left the company with floating rate debt held by the Japanese investment firm and other lenders. Rent and interest payments ate up around 80% of WeWork's annual revenue as of June 2023. WeWork for years struggled to ditch or renegotiate unprofitable leases. In its rush to grow as quickly as possible under Neumann, the company had agreed to corporate lease guarantees that often amounted to years of rent, leaving it with no easy way out. In August, WeWork signaled that it was at risk of going out of business because of the continuing slump in demand for office space and higher than expected member churn. Even though WeWork has amended or canceled hundreds of its leases since 2019, the company's executives continued to warn that its high cost of rent and low occupancy remained a challenge. WeWork Chief Executive David Tolley said, "Bankruptcy changes that we now have the ability to unilaterally reject leases in the U.S. and Canada." 40 New York locations were among the proposed rejected leases on November 7. The company also said it is in active negotiations with more than 400 landlords to amend existing leases. David Tolley said the company was seeking to avoid filing for Chapter 11 by negotiating with landlords and reducing its rental costs. However, in court papers on November 7, WeWork said that because of the company's limited financial resources, it didn't have sufficient runway to complete an out-of-court rationalization of its lease portfolio. WeWork's locations outside of the U.S. and Canada won't be affected by its bankruptcy. In court papers filed with the New Jersey Bankruptcy Court on November 6, WeWork said that the company owns about $15 billion in assets and carries debts totaling $18.6 billion. WeWork also reported that it owes nearly $100 million in unpaid rent and lease termination fees to various real estate companies and property owners, some of which it says it will dispute before the bankruptcy court. More than 400 other corporate entities affiliated with WeWork also filed for bankruptcy, including many of the individual subsidiaries WeWork has established to run its properties around the world. WeWork has filed a motion with the New Jersey Bankruptcy Court to consolidate all of the cases and be managed as a single bankruptcy proceeding.